Welcome to the deep dive. Today we're jumping into something pretty interesting from Vietnam, this paradox around its shophouse real estate. You've got these properties seeing, well, sometimes amazing capital growth, but the sources we looked at show a really tough rental situation often running alongside that. Okay, so let's unpack this. We're doing a deep dive into what some are calling the Vietnamese shophouse dilemma. Our goal here is simple: to help you understand this pretty complex hybrid asset. We'll look at what drives it, the risks, especially across the big cities like Ho Chi Minh, Hanoi, and Da Nang. Basically give you a shortcut to getting informed.
Yeah, it's fascinating how these places, the Na Phu Thun Mai, have changed. Traditionally, they were genuinely mixed use, live upstairs, run a shop downstairs. But the modern ones, they're often, developer-created financial products, part of these huge master plan communities.
Financial products. So less about the shop, more about the investment vehicle itself.
In many cases, yes. They're engineered, really, designed to tap into market optimism, sometimes, frankly, a bit detached from whether a business can thrive there right now. That's a key thing for you to grasp.
And you see that reflected in the marketing, right? Our sources highlight phrases like prime location, limited supply, high liquidity, and that dual benefit capital gains and rental income. We saw figures for Hanoi, for instance, suggesting, 11–16% average annual capital growth over the last 5 years. Pretty impressive on paper.
It is. But that begs the question, why the big disconnect? Why the strong capital growth on one hand and the often weak rental reality on the other? I mean, Vietnam's economy is booming GDP growth, over 7% last year, huge foreign investment, rapid urbanization, a rising middle class. All sounds great for real estate. Yet these shop houses are running into headwinds. You've got the massive shift to e-commerce, plus serious competition from purpose-built, professionally managed shopping malls.
Right. And here's where it gets really interesting. This tension, this paradox, it plays out very differently depending on the city. Let's start with Ho Chi Minh City. Our sources called it a coiled spring. What did you find most striking there?
Well, the coiled spring analogy seems apt. HCMC is really supply constrained. There are significant regulatory hurdles holding back new projects, so you get this huge pent-up demand, specifically for projects that are legally sound, that have all the permits in place.
So scarcity driving value, but only for the legally clear ones.
Exactly. We saw landed property prices actually down maybe 28% year over year in Q4 2024 overall. But then a new fully legal project like Eaton Park launches. Okay. Boom, 90% booking rate almost overnight. It shows how crucial that legal status is. It's paramount.
Okay, but what about the rental side in HCMC? Still facing those headwinds?
Oh, definitely. The rental market there is softening. Prime spots like District 1 saw townhouse rental prices drop maybe 24–26%. So even in a tight supply market for sales, renting them out is tough.
Okay, so HCMC is coiled. Then we look at Hanoi. And the sources paint a starkly different picture, almost the opposite problem.
Absolutely. Hanoi's been flooded with new supply. Almost 3,900 new landed properties launched just last year. That's like an 11.7-fold increase year on year. Massive.
Wow. And that fueled prices.
It fueled a huge speculative boom. Prices shot up, 101% year over year in Q4 2024. Over $11,900 per square meter on average for new launches.
But is anyone actually renting these places? What's the reality on the ground?
Well, that's the gloomy reality, as one source put it.
Right.
Widespread vacancies and rental yields. Critically low, often under 3%, maybe 4% if you're lucky.
So negative cash flow for a lot of owners, especially if they use leverage.
Precisely. It's become a kind of field of dreams bet for many. Build it, pay the high price, and just hope the commercial activity, the tenants, will eventually show up.
Sounds like a classic speculative bubble sign prices detaching from the underlying income potential. Is the argument just that they're playing a very, very long game?
That's the gamble, yes. Banking on future urbanization eventually catching up to justify today's prices. But it's high stakes. It needs deep pockets and a lot of patience. You're betting on the future, not investing in current viability.
Okay, so HCMC is tight. Hanoi looks bubbly. What about the third major city, Da Nang? How does it fit into this?
Da Nang is kind of its own animal. Its market is heavily driven by tourism. You had, 9.3 million visitors in just the first 10 months of last year.
And that helps the shophouse market there.
It seems to. Rental yields are healthier, maybe in the 4.2–4.5% range. The outlook is generally more positive. Shophouses there seem to function more as, let's say, niche commercial assets tied directly into that service and tourism economy.
Less speculative, more fundamentally driven by existing demand.
That's how it appears, yes. More connected to the immediate economy.
So if we tie this all together, what's the big picture for you? I think it's that successful shophouse investment now. It really can't just be about speculation anymore. It demands serious homework, rigorous due diligence.
What should people focus on, though? The fundamentals. Is there actual existing population density nearby? What's the developer's track record? Is the location genuinely strategic, not just marketed as such? And, maybe most importantly, what's a realistic expectation for sustainable rental income?
And be prepared for the long haul, presumably.
Absolutely. You need to think long-term, ideally 5, maybe 10 years. And critically, you need enough capital reserves to ride out potentially low occupancy or even negative cash flow in the early years. Don't over-leverage based purely on hope.
Right. It really sounds like the Vietnamese shophouse market is maturing. That disconnect between the capital values and the actual rental income potential is just becoming too obvious to ignore. So perhaps the era of easy speculation-fueled games across the board is coming to an end. Which leaves a final thought for you, the discerning investor. It's not just about guessing where the market might go next, but about deciding what kind of underlying viability, current income versus future hope, you actually prioritize in your investment strategy.